Let's go back to gold because, it has certainly been shining recently, despite the little pullback that we had today. So let's get a deeper dive on it, if I may say so myself. Harry Watt from Shaw and Partners and Market Matters joins me now. Harry, great to see you there. Thank you so much for your time. Let's talk gold. Like I said, really been, I suppose, the outperformer this year, notwithstanding obviously this little pullback that we've seen today.
Good morning, Carl. It's definitely been strong. It's trading within a couple of percent of its all-time highs in terms of the US dollar gold price. The Aussie dollar gold price punched through 3,000 dollars an ounce not too long ago, and it's tracking around that price at the moment. It's really ripped in the last few months, and that's flowing through into gold stocks more broadly. We did sort of see an underperformance, particularly of the Aussie gold names over the last few months, but that's starting to turn now as well. A bit of M&A helping those gold stocks outperform here. But I think even though we are sort of punching that 2,000 US dollars an ounce price, gold looks really supported here. I think if you see pullbacks like this is probably an opportunity to add to your exposure here in our view, and we're pretty happily long gold across our portfolios at Market Matters as well, Carl. So in our view, I think there's a bit more to run here, a bit more to play out as this year goes on, as this year progresses into 2023 and 24 even. That medium-term, longer-term view is still supportive of gold in our mind. And we can chat some more specific stuff in terms of where to put your money on the ASX and what we like here. But broadly speaking, pullbacks like this, pullbacks like today, Carl, I think we are buyers of it for now.
Yeah, right. So, I mean, we will get into some of those particular names, but in a moment's time. But, I mean, a couple of factors to consider here, just when it comes to the gold price. I mean, is it really a matter of almost just kind of, buying into strength as, rate cuts increasingly get priced into the markets? I mean, I guess by extension, a play on a recession?
Yeah, it's definitely a hedge against recession. It's sort of a little bit of a hedge in your portfolios that I think most investors should have as basically a liquid alternative to sort of hedge against broader market pullbacks. Gold tends to perform well when there's a bit of a risk-off attitude. In saying that, gold performed well as this market's rallied anyway. So we're sort of punching sort of really significant levels on the ASX 200, on the S&P, on the Nasdaq. All equities are sort of been quite strong lately as well, and gold's followed that higher. I think that's sort of pricing in maybe this impending doom that we're seeing out there. There's a lot of market callers talking that we are going to see a big pullback in equities, and I think having a bit of gold hedge in portfolios as a result, I think that's the place to be as well, and it's performed well as well. So it's added to performance over the last 6 months or so, Carl.
M&A activity as well. I mean, it's sort of gripping the space to an extent, perhaps some consolidation there, but we're also seeing some major miners internationally looking at our local players. I mean, how do you read what we're seeing in terms of M&A, and especially when it comes to that sort of Newcrest Newmont deal?
Yeah, M&A in mining's been picking up broadly. You can talk about the Glencore deal, we can talk about BHP Oz Minerals, even though it's a little bit outdated now. But in the gold space in particular, this Newcrest Newmont deal, it does prove that there are buyers out there of assets. It's interesting to see Newmont playing for Newcrest. We're going on many decades ago. It was actually spun out of Newmont. If you're talking into the last century there, Carl. But I think this deal's a good one. It's good for both players. Newcrest shareholders get a fair chunk of Newmont coming out of that one, and a bit of cash as well. That dividend's pretty key, and paying out those franking credits really supports the value in this deal as well. So it's trading a little bit of a discount now. I can understand why there's that discount there. I think Australian shareholders will have to wrap their head around what Newmont looks like post this deal, because they will end up with shares in that new entity listed on the ASX, which is key. But overall, I think this is sort of the start of a trend here. So I think we start to see a little bit more M&A picking up in this gold space and continuing in the mining space more broadly here. I think there's some cashed up miners out there, and I can see why they're going off and picking up new assets and picking up new companies across the board.
Which sort of leads us to the St Barbara Genesis deal, working on a recut, if you will. I mean, how do you see this one playing out?
So they're back out this morning with details of that recut. I think The initial deal, it relied on across a number of different sort of caveats, and St Barbara didn't quite meet them. But they've come back to the table. They sat down for more than a week to recut this deal, and I think that this new situation is positive for both parties. So St Barbara really did need a deal to get done. Their balance sheet was looking a little bit stretched. And Genesis, they really only wanted the Leonora asset anyway, so they didn't want to really touch St Barbara's Papua New Guinean or Canadian assets there. They've been really poor performers lately, and it looks like there's a long turnaround to get them sort of up to spec again. But the new deal sees St Barbara leave with about $200 million in cash. They'll pick up about 15% of the combined entity as well, with an option to go to 19 or so percent if a few hurdles are met down the line. But for now, St Barbara's balance sheet will be in a far better position if this deal does go through, with about $200 million in cash. Like I said, it gives them the opportunity to refinance their debt, pay down all their senior debt as well. Gives an opportunity to put some money into those Canadian assets. And the Canadian and the Papua New Guinean asset. I do think that down the line we probably see them spun out or taken out elsewhere, and St Barbara shareholders end up with just cash in the bank and maybe some spin out of those Genesis shares here. And Genesis gets what they want. They've been talking about consolidating that Leonora area in WA for quite some time, and they're getting that Leonora asset in this deal, and that's the main thing. So we've seen St Barbara shares pop a little bit today on the back of that. They've only been open for about 20 minutes at this stage, so it'll be interesting to see how that one plays out. But I think they were sold off really heavily post their quarterly report a couple of weeks ago, and post that update about costs going higher and production being lower and their pretty tight cash balance. And I think this deal solves that problem. The board's sort of come to market and said that they're really supportive of this deal, that they want to push this one through. So from both sides' perspective, I think that they've both come out on top of this deal, and they should be happy with where the numbers are at. Obviously, we just got to move through a few approvals to get there. But for now, I think St Barbara shares should tick higher. Genesis shareholders should be pretty happy with where they're at and what that asset looks like in a few months' time once this deal's done.